Well, we turn now to a multi-state foreclosure settlement targeting the 5 largest banks. The $25 billion settlement was lauded as a bipartisan effort to bring the banks to justice for kicking millions of people out of their homes. The banks were accused of engaging in this practice of robo-signing, but it looks like the banks aren't really being punished at all. That's because they didn't actually have to cough up most of the fines in cold, hard cash. To discuss this more, I'm joined now by David Diane, blogger for Firedog Late. David, welcome. So robo-signing, this practice of bank employees signing off on legal documents without really looking at them, this recklessly led to this, reckless foreclosures. A lot of people say these people, though, would have lost their homes anyways. So why should we be so concerned about this practice?
Well, there was a massive amount of fraud up and down the chain, starting from origination all the way through the way that these loans were securitized and sold into the marketplace, all the way up to loan modifications and foreclosures. I mean, there are stories of massive servicer abuse, which was also covered in this settlement. People who were foreclosed on when they didn't actually even have a mortgage anymore, that they had paid it off. People whose payments were misplaced and then were, after a couple of years, put into foreclosure. I mean, I don't think there's anyone who has escaped the massive amounts of abuse and fraud that were done up and down the chain in the housing market.
So would you say because of these reckless practices that people were wrongly foreclosed on?
Absolutely. I mean, you can just look at some of the few investigations that we have into these practices. I mean, it's not just robo-signing, which you discussed, but it is losing the chain of ownership on these loans, so that I mean, we have cases of 2 banks closing a foreclosure on the exact same house because the banks lost track of who actually owns the loan, so that the right person has the means to foreclose. And this gets back to, the rule of law and property rights, which are hundreds and hundreds of years old, and what some economists say are what delineates developed nations from developing nations. So this is really serious stuff that was done, and as I guess we're going to talk about, the settlement itself was really not even a slap on the wrist. And, want to play this clip from President Obama after this settlement came out, kind of him praising what the settlement was all about. Let's take a listen to it.
We have reached a landmark settlement with the nation's largest banks that will speed relief to the hardest hit homeowners and some of the most abusive practices of the mortgage industry, and begin to turn the page on an era of recklessness that has left so much damage in its wake.
Well, there you see President Obama, another politician, lauding the settlement as bringing relief to homeowners. But have homeowners really seen significant relief?
Not very much yet. We just got a report from the Office of Mortgage Settlement Oversight. This is the monitor that was put in place to basically find out how much relief has gotten from the banks to homeowners. And there was a big top-line number that was put out saying, consumers get $10.6 billion in relief. Sadly, how that actually worked out, hold on a second, I'm sorry. How that actually worked out was that $8.6 billion of the $10.6 billion was from short sales. And now what a short sale is, it's basically a foreclosure without the messy process. I mean, a short sale is where a homeowner who's underwater does a sale of the home, and then the bank forgives the difference between the actual sale price and the end result price of how much they owe on the mortgage. So it's basically the bank saying, okay, we know that you're underwater, that there's no way you're ever going to get this right, and we're going to forgive the rest of that balance. But what happens in that case is that the homeowner loses the home. They get out without having to go through the foreclosure process. They don't they don't get a credit hit. But really, this is something the banks have been doing for at least over a year now. They escape having to deal with the foreclosure process, which has been tripping them up because of the documentation errors that we've discussed. They get a sale price that is probably higher than what they would get post-foreclosure. And, they're in better shape, and it makes economic sense for them. So the idea that this is a punishment, that they can satisfy some of this settlement through short sales is really ridiculous, because it's something they were already doing before the settlement, and something they're happy to do because it makes economic sense for them in these cases where they're going to foreclose on this borrower anyway.
Okay, so you think this practice of banks, the banks using this practice of short sales is them kind of gaming the system?
Well, partially. I mean, a short sale is certainly a better idea than a foreclosure. What it isn't is a punishment. I mean, the banks make out fairly well. The homeowner makes out better than in a foreclosure, but it doesn't. The homeowner does not get to keep their home. And there is a bit of a gaming of the system going on, because basically what the bank is doing is saying, we're not going to go after you for the rest of that money. If we get a sale price that is less than what you owe on the mortgage, we're not going to go after you at a later date for the rest of that money. Well, in 12 states in the country, which are non-recourse states, the banks can't go after someone for the rest of that money in the event of a foreclosure or a short sale or anything. So what you have is a bank getting credit for a punishment, for a penalty that they have to pay for something that they couldn't actually do, which is go after a borrower after they sell the home in a deficiency judgment, or whatever you want to call it. So there is some gaming going on, and about mentioning those 12 states, $5 billion of the 8.6 or 8.7 billion that actually has been counted by the Office of Mortgage Settlement Oversight in these short sales were in non-recourse states, particularly in California and Arizona.
Okay.
So,
So in the end here, David, are banks really being held accountable?
I mean, you just have to look at it this way. The settlement has been in place for 6 months. After this 6 months, there have been 7,000 borrowers who have gotten relief in terms of a principal reduction, which was the purpose of the consumer relief, we were told, at the beginning when the settlement was inked. We were told that 1 million people would benefit from these issues. And the settlement itself was $25 billion when we have $700 billion in negative equity. It was always a slap on the wrist before. But as we see it roll out, a very, very small amount of people are actually getting the relief that they were promised. And most of the money is, most of the credit for on the part of the banks is being done in things that they were already doing. And I don't know how you can call that punishment at all.
Wow, David, very interesting. Thank you so much for coming on the show. That was David Diane, blogger for Fire Dog Lake.